So basically, term life insurance means it's paying for life insurance during the term which is specified by the policy. So, for example, there's options of 10-year term policy, 20-year term, 30-year term. You're going to hear those quite a bit. Basically, a 10-year term means the payment is set for the 10 years that the policy is in force. It does not mean the policy runs out at 10 years. What it does mean is that the 10 years is where so let's say your payment is $50 a month. Your payment's going to stay stable at $50 a month for 10 years. After that, it will raise every year after that according to age. So example, if you bought the policy when you're 25, it's going to stay stable for 10 years. At age 35, now all of a sudden that payment's going to go up every year according to age. As most people do know, maybe you don't, that life insurance is dependent upon age for price. Why? Because every year we get older, the year we are closer to natural death. So therefore, it's less time to pay for it. So therefore, it's more expensive per year. And that's during that time. So let's say you're 25 years old and you did a 30-year term. And let's say your payment's $100 a month. Your payment until age 55 is going to be $100 a month, and then it's going to go up from there if you continue to carry that policy. What term life insurance does is it's able to get quite a bit of coverage and not much payment. And, in times where we got a budget we have to deal with, which all of us do, it just depends on what our budget could be. $30 a month, our budget could be $500 a month. Or, what it may be. Term life insurance is a good way. A lot of times what I tell people, if we can't get enough coverage under what we would call a whole or index universal life policy that's good their entire life and the payment stays the same, is we supplement that during their earning years with a term policy. You can have more than one life insurance policy. So for example, let's say we come to a figuration of where we need $1 million, but we can only afford $500,000 in a whole life or index universal life policy. We'll try to supplement that. Let's say you're age 35. We know we're going to work another 30 years is the plan. Let's try to supplement those earning years with another $500,000 policy. And we can do that with term at a quite a bit less rate than we can whole. Reason is term is all you're paying for is the death benefit. There's no investment part with that, like there is a whole or index universal life policy. Therefore, that is a good supplement. It's a lot less expensive to do it that way. Now, would I recommend this for somebody? It depends on the situation. There are good times for term policies and not so good terms. I'm going to be honest, if you're 25, 26 years old, and you're just kind of starting out, I'm always going to recommend a whole or index universal life policy because that payment's going to stay the same and you're at one of your cheapest or most inexpensive years to pay for it. So for example, let's say you need $500,000. A 30-year term might only cost you, let's say $100 a month. But if you can do $125 a month, I might be able to put you on an index universal life policy that's going to get you close to the same coverage, and that payment stays the same your entire life. More times than not, we go buy a 30-year term policy, and guess what happens? We don't pass away during those 30 years, right? It's going to be later on down the road. So therefore, you're going to need something that comes past that. Because if you do a 30-year term policy and then pay yearly after that, the price increase is going to be more than super substantial. So therefore, don't we want to keep the payment close to the same? So if we can pay an additional $25 a month now, wouldn't we rather do that than pay an additional $300 a month down the road? So something just to keep in mind on that. Also, term policies do not build any cash value. They are death benefit only. There is no investment tied to it. Therefore, they are just a straight, you paid for $200,000 worth of coverage. Guess what? When you pass away, if you pass away during those times, it's $200,000. There is no, well, you had a cash account as well of $15,000. So now you get $215,000, it's $200,000. It's whatever you set the death benefit at, that's going to be there. There are some riders that you can do on a term insurance policy, especially if you have young kids. You can put them on there as well in case something happens to them, God forbid, during their minor years to help cover burial costs, funeral costs, things of that nature. There are some small other ones as well, like critical illness is sometimes on there, a chronic illness for an additional charge. There are some additional things you can put on a term policy, but for the most part, what you're paying for is strictly a life insurance policy. It's not an investment, it's not a wealth building portfolio thing. It's just a term policy. God forbid something happened to you. Your family's going to need money, your spouse is going to need money. So let's say you had a $400,000 mortgage. When we signed up, we probably took out $400,000 worth of life. Let's say you passed away during the first few years, a car accident or something to that effect. It pays out the $400,000. Therefore, your spouse or your family could pay off the house, and now they have a free and clear house to live in order to keep your family somewhat stable. A lot of things happen when one of the partners passes away. Okay, so let's say we're married and our spouse passes away. There's going to be a lot of things going on. A lot of questions come into play. Where am I going to live? Where am I going to do this? So that term insurance or mortgage insurance kind of plays in a part there to pay off that mortgage, to at least take one of those obstacles out of the way and one of those fears out of the way if you were to pass. It's hard enough to get on with life if somebody you love passes, let alone having to make life-altering decisions after that for the remainder of your family. So just something to keep in mind there too. So term insurance is the basic life insurance of everything, right? So it's the most basic life insurance. It's a question typically of how long you want it to run. The shorter the term, the less expensive it is. So 10 years obviously going to be less expensive than a 20. 20 is going to be less expensive than a 30.